Welcome to the Deep Dive, your shortcut to becoming instantly well-informed. Today, we're digging into something pretty fascinating, a financial mystery, really, that just unfolded. Figma's IPO.
Yeah, even if you're someone who follows the markets closely, the numbers involved with Figma, well, they were kind of staggering. On the surface, it looked like, wow, a huge success, right? Figma's stock just exploded. It went from an offering price of $33 to closing over $115 on the first day.
Right.
It's a 250% jump in one day.
Massive.
Yeah. So Figma's valuation shot up from, like $19.8 billion to over $47 billion.
Incredible numbers.
Sounds amazing for Figma, but, and this is the big but, there's this paradox. That initial price, the $33, it seems it was way too low, so low, in fact, that it might have cost Figma and its stakeholders, founders, employees, early investors, something like $3 billion in cash they could have raised.
And that $3 billion miss, that's really the heart of what we're diving into today, IPO underpricing.
So our mission isn't just about Figma specifically. It's about understanding how this happens. Who actually wins here? Who loses?
Right.
And maybe most importantly, what lessons can founders or companies learn if they're thinking about going public down the road?
Okay, let's unpack this then. You mentioned the source material says the offering was oversubscribed 40 times.
40 times. Yeah.
40. I mean, that sounds less like a signal and more like a giant neon sign flashing, you priced this way too low.
Exactly. It's like, imagine trying to sell a concert ticket for $33 when there are 40 people screaming they'll pay $115.
So what does that huge demand really tell us?
Well, in simple terms, underpricing just means that the IPO price was set significantly below what investors were clearly willing to pay.
Right.
And this gap, it creates a situation where, some people make out like bandits.
The institutional investors mainly.
Absolutely. They were the big winners here. They got shares at $33, watched them leap to $115 plus.
That's a 250% gain basically handed to them.
Pretty much. Collectively, the estimate is around $3 billion in profit just on that first day jump.
Wow.
Meanwhile, Figma itself, the founders who built it, the employees, they missed out on raising that extra $3 billion. Capital they could have used.
So it was a real cautionary tale.
Definitely. For any founder.
So is this just like a big oops, a mistake? Or is there something in the way traditional IPOs work, the whole machine, that kind of allows this? Or maybe even encourages it?
That's the key question, isn't it? And no, it's generally not seen as just a mistake. The mechanics of the traditional IPO, especially the role played by the underwriters, kind of sets the stage for this.
The underwriters, they're the investment banks managing the deal, right?
Exactly. The lead underwriters or bookrunners, they're crucial. They basically determine the share price and who gets the shares.
So they run the whole show.
Pretty much. Albert Vanderlyn, he's a partner at Oric LLP. He describes them as like the conductors. They handle the legal stuff, the due diligence.
The road shows where they pitch investors.
Right. Building that book of orders, figuring out who wants how many shares, and then advising the company on the final price and allocation.
Okay, so they're gauging interest, but why price it so low if demand is sky high?
Well, the conventional thinking is that underwriters often prefer, let's say, a more conservative price.
Why is that?
The idea is to ensure a smooth debut, a nice first-day pop in the stock price, looks good, creates buzz, keeps their institutional clients happy.
The clients.
Right. But with Figma, that 40x oversubscription, it just screams that conservative went way too far into, leaving billions on the table.
Okay, and this is where it gets, I think, really interesting for a lot of people. If it's underpriced, who actually gets to buy at that low $33 price? Is it open season?
Not really, no.
My understanding, historically, is that something like 90% of IPO shares go to the big guys, institutional investors, and maybe 10% for retail investors like you and me, often through some kind of lottery.
That's broadly still the case, unfortunately. That allocation imbalance is a persistent feature.
So the big funds, the institutions, they get the vast majority of this underpriced stock.
Yes, they get the lion's share, often ready to flip it pretty quickly for those large gains we talked about.
While the average person might get a tiny allocation, if they're lucky.
Exactly. It's a structural advantage, really, built into the system for those large players.
Okay, we see how it can happen, but let's be really clear now. When a company like Figma leaves, potentially $3 billion on the table, who pockets that money and who really loses? Let's break down the winners and losers here.
Sure. So on the winner side, number one, definitely the institutional investors.
The ones who bought at $33.
Precisely. Buying at $33, selling potentially over $115 on day one, that's a massive return. Like we said, estimated $3 billion profit collectively almost overnight.
Just for getting that initial allocation.
Right. And then you've got the investment banks, the underwriters. They win too.
How so? Beyond their fees, I mean.
Well, yeah, they get their fees, which are significant, but maybe more importantly, they solidify their relationships with those big institutional clients.
By giving them access to these hot deals.
Exactly. Good access means happy clients, which means more business down the line for the banks. It strengthens their position.
Okay, so those are the winners. Who's on the losing end?
Well, primarily, Figma's founders and its employees.
How does it impact them?
Think about it. Years of hard work, building incredible value, and a significant chunk of that value gets transferred on day one to investors who just bought the stock.
Because their own stock options or shares are implicitly valued lower at the IPO price than the market clearly thought they were worth.
Exactly. Their equity didn't reflect that true market demand revealed moments after trading started. And of course, the company itself loses out.
Figma, the entity.
Yeah. That $3 billion could have funded years of growth, R&D, acquisitions, whatever they needed. It's capital they didn't raise.
So this wealth transfer, you're saying it's not an accident?
No, I mean, experts argue it's a well-known feature, almost a consequence of how the traditional IPO process is structured. It tends to favor those large institutional players.
So for founders listening, maybe someone thinking about taking their company public. What are the takeaways here? Figma's story, even with the underpricing issue, must offer some valuable lessons, right?
Oh, absolutely. I think one key lesson is really understanding how to gauge market demand and investor interest before you set that price.
Like that 40x oversubscription being a giant red flag.
Right. If you're seeing overwhelming interest during the roadshow, that should tell you something about potential underpricing. Founders really need to listen to what investors are signaling they're willing to pay.
There's a quote here from Lewis Hauer at Silicon Valley Bank.
Yeah, Hauer says founders need to grasp the factors that maximize valuation and make new investors want to come in at the highest price possible.
So figure out what makes your company worth top dollar to incoming investors.
Exactly. And then translating that interest into an actual valuation and price, that takes really careful planning.
It's not just about the demand then.
No. You need clear, achievable targets. You need to know exactly how much capital you need before you even start the IPO process. And timing, of course, is huge. Market conditions, what competitors are doing.
And the risk of getting that price wrong, of underpricing. It's not just missed money, right? It affects ownership.
Definitely. It reduces the cash you have to grow, obviously, but it also increases the risk of dilution for founders and early shareholders.
Dilution, meaning their ownership stake gets smaller.
Yes. Lewis Hauer points this out too. He says dilution is pretty much inevitable when you raise capital, but founders need strategies to minimize its impact.
How do they do that?
Well, one key thing is keeping a really clean and organized cap table.
The capitalization table, who owns what?
Right. And understanding deeply how every pricing decision affects every single stakeholder, it's crucial for protecting your equity.
And we should probably stress again, Figma had the goods, right? That's why the demand was so insane.
Oh, absolutely. They had fantastic fundamentals. Consistent recurring revenue, super fast growth, good margins, customers who loved them and stuck around.
That's what justified a premium valuation in the first place.
Totally. They built the rocket fuel, as you said earlier. The IPO process maybe just didn't capture all its value initially.
Which brings us to a really important question. Is the traditional IPO the only game in town? Are there other ways to go public that might, better reflect that true market value and avoid leaving billions on the table?
Yeah, that's a great question. And the answer is yes, there are alternatives. Founders do have other paths they can consider.
Like what?
Well, one big one that gets talked about a lot is a direct listing.
Direct listing? How's that different?
So you basically skip hiring underwriters in the traditional sense, and you don't issue new shares to raise capital initially. Existing shares held by employees, early investors, they just become tradable on the exchange.
And the price is set by?
Market demand. Pure supply and demand on day one. Spotify did this back in 2018.
Right, I remember that.
Yeah, they saved a fortune, maybe $300 million, in underwriting fees and didn't dilute the existing shareholders with new shares at that point.
What's the catch?
Well, it requires a lot more internal prep, really meticulous investor materials, a super strong investor relations game from day one, because you don't have the bank guiding everything.
Okay, so direct listings. What else?
Then you have SPACs, special purpose acquisition companies.
The blank check companies.
Kind of, yeah. They're basically shell companies that raise money through an IPO first, with the sole purpose of finding a private company to merge with and take public.
So it's a faster route.
It can be, and it offers some price certainty earlier in the process, which can be attractive, especially if the markets feel volatile. Virgin Galactic went public via a SPAC merger.
Right, with social capital Hito Sophia.
Exactly. The success there, though, often really depends on the quality and reputation of the SPAC sponsor.
Got it. Any other main alternatives?
One more worth mentioning is partnering with private equity firms.
How does that work as an alternative to going public?
Well, instead of a full IPO, a PE firm might invest significant capital, bringing not just money, but often operational expertise, industry connections. It can be a strategic step. CrowdStrike took a big investment from Warburg Pincus before their eventual IPO.
You're still private, mostly.
Often, yes, or it might provide only partial liquidity for early investors. And you usually give up some control. So like all these options, traditional IPO, direct listing, SPAC, PE founders really need to weigh the pros and cons carefully.
Align it with their goals, the market.
Exactly, and make sure they have the leadership team ready for the scrutiny that comes with being public, whichever path they choose.
Now, speaking of scrutiny, especially around traditional IPOs and underpricing, we absolutely have to talk about Bill Gurley.
Oh, yeah. Benchmark's former general partner. He's been a very loud critic for a long time.
And he was very vocal about Figma, wasn't he?
Yeah.
He called that 250% first-day pop a gross inefficiency, so the whole process is broken.
He did, unequivocally.
What was his core argument about Figma, specifically? Why was he so outraged?
His argument, basically, is that the underwriters intentionally underpriced Figma's stock.
Intentionally, why?
To guarantee that huge pop for their institutional clients. He sees it as leaving billions on the table that rightfully belong to Figma and its early stakeholders, the people who built the value.
So, enriching the bank's clients instead of the company?
That's his take. He sees it as a deliberate wealth transfer. He actually tweeted on July 31st, the day of the IPO.
What did he say?
Something like, with 5ag, we have another massive POP highlighting the gross inefficiency. It's very simple. They refuse to match supply demand. They brag about the mismatched 30x oversubscribed. The outcome is expected and fully intentional.
Wow. Fully intentional.
Yeah. And that's why Gurley has been such a huge advocate for direct listings for years now. He believes it lets the actual market set the price and stops this kind of wealth transfer, letting the company capture that pop value itself.
Okay, so looking back at this whole Figma saga, what are the absolute key takeaways?
Well, I think there are a few clear lessons. One, strong fundamentals are everything. Figma had them. That's why there was so much demand.
Right. The foundation matters.
Two, pricing is incredibly nuanced, and getting it wrong can cost billions. Three, that wealth transfer in traditional IPOs, it's real, and founders need to understand that dynamic.
And the alternatives.
Yeah. Four, exploring alternative paths like direct listings or SPACs might be crucial for some companies to capture more of their own value. It's about knowing your options.
So understanding this whole IPO game, the pricing, the players, it's really critical for any company aiming to maximize its potential when going public.
Absolutely essential.
Which leaves us with a final thought for you, the listener. As you think about how companies go public, maybe companies you invest in or admire, what really stands out to you about this idea of market efficiency when potentially billions of dollars are just left on the table on day one? Something to chew on.